Okay, let's take a peek at chapter 3. Chapter 3 has to do with the adjusting process, right? Everything we do in this chapter is about the adjusting process. We're going to talk a lot about what that is, and then go through some examples of different kinds of adjustments that we do. Before we do that, we need to kind of remember some things, right? Remember that in accounting we have that time period assumption, right? That says that we can bust the world into time periods. So if we look at like a calendar, right? So there's December 31st. That would also be what? January 1st of the next year and December 31st, right? So I have 2 years here, right? When we analyze and we prepare financial statements, we are preparing for one specific accounting period, right? So that's that time period assumption. So we break the world up into time. Now, we generally look at this as a year, right? And then if we prepare financial statements in the middle, we would call them interim financial statements, right? Now, we have this time period assumption, right? So we're keeping track of things for a period of time. The way we do that is through the implementation of this accounting cycle. Now, we've started looking at what this accounting cycle is. Last chapter, in chapter 2, we looked at journalizing transactions, right, and posting them to the general ledger. Well, those are things that happen all throughout the accounting period, right? And then at the end of the period, we have to kind of do our little magic and prepare our financial statements and get ready for the next year, right? So adjustments are the next process in that accounting cycle, right? So that's one of the very first things that we do at the end of the time period or the end of the accounting cycle. Also remember that we had those concepts called the revenue recognition concept or principle and the matching principle, right? Revenue recognition and the matching principle. Revenue recognition says I recognize revenue when it's earned, not when I receive the cash. Matching says I have to match expenses to the period that we generated revenue, right? So if you think about it, I could earn in this period and not get paid till this period, right? But I'd recognize the revenue back in here, and then I'd have to count the money here, right? But it's important to recognize the revenue, right? And I might have expenses that happen here, but I don't have to pay for them till the next period, right? Well, there's still expenses to us when? In this period. So I need to make sure that I capture those things at the end of our accounting period, right? So that is the purpose of these adjustments, is to bring our accounts up to date and to match expenses to the period that they generate revenue and to match the revenue to the period that it was earned. Okay. Now we got a couple of definitions that we want to talk about, right? Calendar year, we know a calendar year is what? January 1 till December 31, right? So that's easy. We already knew that. A fiscal year. What a fiscal year is just means what? 12 months in a row that we keep track of for financial statements, right? So businesses don't have to follow the calendar year. They can run from July 1st to June 30th of the next year, right? And that would be their fiscal year. Still 12 months in a row that ends when we decide it ends, right? Now, if we talk about the concept of a natural business year, it's, again, 12 months in a row, but we want the end of that natural business year to be when our activities are the lowest, right? So if you think about Walmart, right? What's going on in Walmart on December 31st? Well, people are still in line bringing back their crappy Christmas presents, right? So Walmart is hectic and busy, and their inventory is coming in and out and all those kind of things, right? It's a busy time of year, so they wouldn't want to end their year when it's busy. If you think about when Walmart's going to be slow, it's going to be when? End of January, right? After everybody spent all their money and they're broke from Christmas, right? And there's not much going on. So if you look at most retailers, their fiscal year is going to be like from February 1st till January 31st, or their natural business years. And they'll choose that for a fiscal year, right? So, a couple of definitions that we have there, right? Now, the next, the last thing that we're going to talk about in this little video is preparing us for the next set of them, right? We are going to learn how to do these adjustments, right? There's a couple different kinds of adjustments that we do. We do something called deferrals, and we do something called accruals, right? And defer in our context means to do what? To put something off, right? To postpone something. And to accrue means to bring something in, So So what we do with deferrals is we postpone, or something has been postponed, and here it's being brought into the system, right? It's being brought into the system. What I want you to keep in mind, right? If you mark this as the point where we recognize revenue or expense, right? And this is a timeline, right? Sometimes the cash is going to change hands before the recognition of revenue or expense, and sometimes the cash is going to change hands after the recognition of revenue or expense. The way this works with deferrals, the cash changes hands, then later down the road we recognize revenue and expense. With accruals, cash changes hands after we've recognized that revenue or expense, right? So here cash changes hands before recognition, here recognition happens before cash changes hands, right? So deferrals are always going to be one thing that turns into another thing, and accruals are just going to be us bringing something in. Okay, so I know this probably isn't going to make much sense to you right now until you take a peek at the next 4 or 5 videos. I'm going to do a little example. There are a couple kinds of this and a couple kinds of that, right? Deferred expenses and deferred revenue, and accrued expenses and accrued revenue are the 4 things that we're going to do. Depreciation also falls into this context, and we'll take a peek at that as well, right? So the next thing we're going to do is look at how we do these adjusting journal entries, right, to bring our accounts up to date, to match expenses to the period that the revenue was provided, and to match revenue to the period that it was earned.